Good afternoon, everyone. My name is Josip Causic. Today is May 23rd, 2023. If you can download the SpeakUp app and type in today's chat room key, 95225, then you can have a direct access to me. I'm going to type in here hi to everybody who is in this room, and then you can um, interact with me and ask me questions about the material that we are presenting. So this is a special monthly session here, and I just want to make sure that you take a moment here to read the disclaimer, because we're not financial advisors. We do not provide any financial advice. Everything is for educational purposes only. So please read this disclaimer, even if you need to stop it. And if you want to get in touch with me, here's an address where you can get in touch with me. And I want to show you today's agenda. So when we start, we're going to have two parts. The first part is going to be simply to go over the big picture overview of what the market is doing, and then we're going to jump into trading. So having said that, I will now bring in the platform, which is already open with 4 charts. So the 4 charts that we're going to be examining are the charts of the Dow Jones Industrial Average ETF, NASDAQ, S&P, and Russell 2000. So when I enlarge this chart of the Dow Jones Industrial Average, I just want you to focus on here on this section, which is the low of the market crash. And then also to focus on this low, which was basically the low of the last February when that war in Ukraine commenced. And if I just take a simple yellow line and draw at that level, you will notice that the market has collapsed below that level and was really struggling to get up above it. And when it got up above it, that level was again acting as some kind of resistance and a support. But that's the situation on Dow Jones Industrial Average. I'm going to pull it up now, Russell 2000, which is really the market that tracks the bigger picture, which is everything in terms of the small caps, and often it's not as looked at as any other market such as a NASDAQ or S&P. And when I draw that same February of the last year, you will notice that currently we are approaching that level, but we are really struggling and we are below it. So this is very important to know, because obviously if the NASDAQ or let's say S&P or even Dow Jones, which I show a minute ago, are above it and Russell is below it, this means that the US market is not beating on all cylinders in the same direction. It's almost like it doesn't matter that right now the monthly bar, this monthly bar for the Russell 2000 is up, when in reality we are still, in comparison to the other market, way below, way below. So of course, looking at the Russell and looking at the Dow Jones is not enough. So we would need to also look into what is the Nasdaq doing. So again, this is the last year over here, February, and when you're looking in relationship to the February, Nasdaq is above that line, and S&P 500. When I enlarge it right here, I have even inserted the moving average, which in this case, it's really interesting if you want to just observe the situation that this moving average, when it came to that February of the 2022, when that war commenced in Ukraine, was acting as a kind of support till it didn't. And then when we broke below it, the price action of the S&P 500, which is the greatest measure of what the US market is doing, was acting like a resistance. As of now, it's not just that horizontal line that matters. What really matters is that this moving average is acting as a somewhat resistance. So if this was analyzed only from the strictly technical analysis perspective, using the one simple dumb down horizontal line, you would say like, well, this market is up, therefore market is bound to go higher. But when you take a living thing like a moving average, this month of May is still not closed. We have about a week of trading left. Whether or not we're going to close it above, it remains to be seen. So what I'm trying to do with this big picture every single time when we meet here on a monthly review is just to kind of point out to you, and again, I have taken a snapshot over here of all three of them side by side, to kind of point out to you a very simple concept, and that is that this line that is currently yellow line that represents the February of the last year is a line in the sand that market needs to close. And of course, we have a situation that the 3 out of the 4 are above it. Dow Jones is above it. The Nasdaq is above it, and S&P 500 is virtually sitting on it, while the IWM or the Russell is right below it. Well, this is a question that I want to pose. Then what can you do with that information? What you can do with that information, you can practically apply that information in today's market. So when I now switch from a monthly to today's market, I have a Forex factory open up here, and I have filtered only by the several things. For instance, I care only about the US market in this particular session. So out of all these currencies, I have unchecked all of them but US market. And again, in terms of the impact, I like to keep the red flag or the high impact expected, and also the medium impact. These lower ones, such as low impact, like something like a car sales or similar like that, or a non-economic, I'm not even showing. So in today's session, when you're looking right here, what has happened is that we have a situation that we had a manufacturing PMI. And if you're not sure what that PMI is, you can just click here, details, and you can find this one area that says right here, why do traders care? So it's an economic indicator that shows economic health. So when I now show that this has happened before we even looked at the market, you will see what the price action has done. Dow Jones has gapped down on the bad news, and ever since then it has rallied up and closed the gap. Nasdaq has rallied, but it still has a little bit of the room to close it. So that's mean the gap hasn't been closed on the S&P and Nasdaq, but then that forgotten member of the society, or the IWM, is the one that I want to focus on. So when you're looking at the IWM, it's up for a month, but again, as I pointed out to you, it's well below this February of the last year low, and it's actually running into it. The question becomes, what are you going to do about it? Can you trade this, or should we go and trade something that is more safe? So what I'm planning to do right now, I'm planning to actually trade the QQQ inverse product. And the QQQ inverse product is this product that is a QID. So this QID is currently sitting at the $16. So it's a pro shares of the QQQ, but it's ultra short. That's mean when it goes down in the multiples. So the way how we're going to do this in this trading session is I'm going to bring in here Thinkorswim platform in a moment, and I'm going to create a synthetic on a QID. And I'm going to go out to as far as January 2025. And I'm going to pull up the $16 put that I'm going to be selling. So to kind of simplify these things, what I'm going to do, I'm going to actually walk you through these things and type in the plan that I'm doing. So QID is currently sitting at the $16 and let's say 11 cents. If I sell to open put, that is actually double negative, which means that's a bullish trade. Okay, and I'm selecting the long-term options that expires in basically 2025. So when I go over here and I select this particular product, that right now it goes for a bid of the 320 and a ask of the 370, that $320 is going to get subtracted from the cost of the 16. So now just capture this and make sure that it's clear what we are doing here. So what I have here right now is all the information that I need in order for me to place this trade. So information that I need to place this trade is right here. This is the intrinsic value column that it's showing me that currently we're really sitting at the 608. How do we know that we're sitting at the 608? Because the value of intrinsic put for 17 is worth only 92 cents. 92 cents. So if we now walk backwards, 17 minus 92 cents, it's giving me the current price of the 1608. So 1608 is where the QQQ currently is. And I want to make sure that we follow what we are doing here step by step. So if we're now at the 1608 and we want to just sell to open the 16 put, the 16 put that is a bullish trade would tie up $1,600. But because I'm going to be receiving the credit of the 320, right? So I'm taking the obligation to purchase QID at the 16, which ties up $1,600. I will be getting the discount on this long-term options of, so discount of the $320. So what I'm going to do right now, I'm going to just point out to you that when I click the mouse right here on the bid, single right click, and I go over here where it says sell vertical. Oops, I'm sorry, I misspoke, not to sell vertical. I'm going to just sell a single, which is a 16 for 320, and I'm going to confirm here, but I'm going to take a snapshot of this ticket. And again, everything is being done in the paper trading account. Everything is being done in the paper trading account. You're going to get all this information cut and pasted in here. So what I'm doing here is simply explaining that this 1600 is what really should tie up my capital. But because they give me this 320 right here, which is positive thing for me, so I'm going to make this into dark green. When you subtract the two things, it really comes down that only amount that going out of my account is $1,280 plus, of course, like over here, I need to pay them the commission of the 65 cents. So be aware of it that 65 cents, it's not that I'm really paying. They are owing me $320. So net out of the their money to me, I will be receiving the $319.35. So I'm going to just snapshot this so this can be clear, because in the moment when I fire this trade in, I want to show you how this thing works here under the cash. Okay, I got filled for 320. Actually, I got improvement of the 340. This is even better, right? So over here it says you were asking for 320, but you got the 340. So right now it's 8:16 California time. We got filled for $3.40. I want to make sure that I'm following everybody who's here in the speak up. Hi, Josip. Good to see you here. Any question, type it in. Okay, Okay. So if you have a question, feel free to type it in. I want to make sure that I work through this whole thing and explain it what happened. So the bid and ask at the time when we were doing was the 320 with the ask of the 370. So when you look at that, you are obviously aware of it that spread is pretty wide, right? So every time when you have a bid and wide, you also have a mid price. So if this is a bid at the 320 and this is a ask, and I'm going to just insert one more column here so it's going to be easier to kind of follow what we are doing here. For 370, what do you think it's in the middle? Well, in the middle is the difference of the two. So this would be about a 50-cent spread. 70 minus 20 is a 50 when you divide by 5. The mid is supposed to be exactly at basically 355. 3 plus 345. 345, right? Because when you divide the 50 cents by 2, it's the 25 cents. Adding the 25 cents on the top of the 320 gives that. But I have gotten filled for slightly less than that, which is a 340. That's how my fill is. So let me recap this one more time, right? I took a snapshot of the bid and ask. So this was a bid at the 320. This was an ask at 370. I have clicked here on the sell because every time when we were selling to open, we're selling to open at bid. So we sold to open at bid, but in reality, that turned out to be mid. So mid price, and by the way, it was a paper trading account, right? So now what do I have? I have an option that I control all the way till the 2025. Okay, so one more time, what this has to do with anything? It has to do with what the market is currently doing. So if the expiration comes in right now and we expire at 1610, let's say we expire right now at 1610. So I'm explaining here. At expiry, QID is still above 1610. I have a short 16 put that created the obligation to buy at 16. So that's mean that contract at the expiry is going to be worthless. So my sold to open 16 put is going to expire worthless. So the most that 16p can earn is $320. So you're now looking at this and asking yourself, like, okay, what is the rate of return? So rate of return would be $320 over what? Well, we're not going to count the 16 because keep in mind that instead of 16, how much money did they take out of it? Well, they actually took a 1280. So let's go one more time. So I'm bringing here a very simple thing, which is a calculator, and I'm showing to you that I was supposed to give them 1600. But because they owe me 320, okay, I'm risking the 1280. So now when I'm calculating what is my rate of return, it's a 320 divided with the investment of the 1280. So that is the rate of return of 0.25%, 2.5%, right? So my rate of return in this particular case is 2.5%. 2.5%, but then how much time do I need to be in this trade? Specifically in this trade, I need to be 605 days. So this trade in 605 days earns that much in terms of the percent. Okay, so now let's move on to the next thing, right? Let's move on to the next thing. What about if I really want to look at just the one component, which is called delta? Delta. What is the delta of that position? Just like I have a volume here, I can click here on a theoretical, and I can switch here to delta. That delta is right now 41. Okay, that delta is right now 41. So one more time, I want to make sure that we are clear what we are doing here, and that we are able to have everything set in order here. So we are now going to be creating synthetic long. And a synthetic long is a trade in which I will simultaneously also invest that $340 to buy this 16 call. So part two is we are now buying a call. So buying a 16 call for the same expiry. So there's two parts to it, right? There's a buying the call and there's a selling a call, right? So in this case, I don't want to be complicating these things. So what I'm going to do here, I'm going to pull up our Tradactive single option trade planner, and I'm going to just walk you through it. So I'm going to type in here QID quickly. We're going to change this in 2025, and we're going to be talking about the $16 call. So we're doing $16 call. We already sold here 16 puts. So at this point, because we're just talking about the long trade, I'm going to just get rid of this, and we're going to have that right here. So $16 call. Now notice when I bring up here the $16 call, I'm going to do the same concept here, and I'm going to put a box around the bid and ask, so you would see how wide that spread is. So we have here information that is connected to the values. So if I do it like this, it's gonna actually make much more sense. So one more time, we have a delta of the 60. That's a one piece of information. We have a bid and ask, which is another piece of information. And then we have a movement of the 1 penny, because intrinsic value, it's no longer at the $16.08, but at $16.07. So that means it has moved a penny ever since we entered it. We have all this for the 16 call. So let me now recap all this here in terms of the underlying. So there's no confusion. There's no confusion left. So I'm bringing in here for a part two, which is a buying of the call. Buying of the 16 call. All the information that we need is that QQQ has moved ever since my put entry 1 penny down instead of going up. For that 7 cents of the intrinsic value that has a 605 days, they want $410. Now, just like we had the bid and ask over here, be aware of it that over here we're going to have a bid and ask. So when we have a bid and ask over here, we need to adjust those numbers to see what they are. So 350 is on a bid if I'm selling, but I'm not going to be selling. I'm going to come back to the mid in a second. And over here is the 410. So when you're looking at here at the 410, that's a 60 cents wide spread. 410 minus 350, that's a 60 cents. That means you can add 30 cents on the top of this. So the mid's supposed to be what? 380. So I'm going to try to invest $380 to buy at the mid. So what am I doing next? What I'm doing next is I'm trying to purchase this June contract of the 2025 of the 16 call. I'm sorry, this is supposed to say 25 too. Okay, so I'm looking. Okay, this earnings is not what I need to pay attention to, because this is a product that it's not the stock. it's tracking entire basket of the QQQ, but the ultra short, which is on the flip side. So I'm going to just go down over here and just give you the information about how much I'm going to get filled when I fire the trade in. So what I'm doing right now here, I'm clicking buy a single, and I'm going to drop it to 380. See if I'm going to get filled. Now, again, this is a paper trading account. They might not instantly react, so I will probably have to alter this in order to get filled to the market order, which in reality is going to be very different than what would happen if I was placing this live. But I want to, okay, so they got filled at 380, just like we have calculated. Okay, so we bought, actually, I think it said the 390. Let's just see. Okay, 390. They fill me up to 390. Okay, let's take a snapshot of that. So now I have information that this got filled at the market, while the other one got filled at the limit. This filled at the market at 390. So we're gonna put here 390. Okay, so 390. Now, when I just talk about the delta, okay, talking about the delta. So there's two parts to it again, right? So there's a part for a call side, and then there's a part for the put side. So we have a long call that has a delta of 60. And then we have a short put that has a double negative, which still makes it into positive, of the 40. So two of these deltas, when you add it together, create the delta of 1. So my position right now, my long call plus short put, is synthetic stock. Synthetic stock means that I have 100 deltas. So let me just now go into a different account over here. Over here I have two different accounts, right? So if I switch, let's say in IRA, and I just go simple here and I buy this 100 shares. So I'm going to just click here, buy. I'm making sure that over here quantity is not some crazy quantity, but that I have a quantity of the 100 shares. When I click this, 100 shares at the current price of the 1607 would cost me this much money. So when I send it in, I got filled. In this account, I'm long 100 shares. So when I click over here, what is my delta? 100. This is how normal stuff works, and this is not where you need education. So let me just check here if everybody's following here. Good. Okay, good. I appreciate your comments, so I know that we're good. We're now switching back to the margin account. I want to show you that I actually have a higher delta over here, but I also have a gamma, theta, and vega. While when I was in my IRA, I didn't have anything here except the, oh, you're down $1. Because remember, originally the price was, when we entered the position, the price was at the 608. Okay, so over here we placed the trade at the 1608. Now the price is at 1607. That's why it shows that. So when we have two of these things together that are options, I have synthetically created something that it doesn't even exist. So let me just now explain one more time, what am I talking about? So I'm talking about having two accounts. So this is an account that is IRA, and this account is a margin account. Okay, in margin account, I have spent $1,607 for ownership of 100 shares of QID. No complication. No complication. cost wise, what do I have here? I have a 1280 for the put, plus I have here 390 for the call. So did I get that for less money or did I get that for more money? Well, what do you mean? Okay, so I want to compare this. When I add the $390 on the top of the 1280, what is the outlay of my capital? Outlay of my capital is 1670. Wow, that doesn't make sense, right? In this case, why don't you just simply buy the shares, right? Because obviously you're overpaying by the $63 and you don't even have a right to hold it forever, while the stock you can hold forever. This does not have an expiration because all that we did here, we went into our buying power and we reduced it by $1,607, right? So if you had the balance of the 8,000, as you can see right now, we would then have this now less in amount of that. But if I go into the margin account, oh, look at all these commissions, miscellaneous fees, then what is the advantage? Well, the advantage is that I can now bring up front some credit. And what do you mean by that? Well, that's the second part of the trade. So to recap what we did so far, we had the part one, and the part one actually just involved selling to open a put. That was the part one. Okay. The part two was that we have decided to buy a $16 call. Now look at the flexibility that I have. I have now flexibility because I'm technically speaking along a stock that I can go ahead and I can have a part three. And this part three involves selling the front cycle call. Selling the front cycle call. So we just need to now decide which front cycle we're going to pick. And one of the ways to do that is, of course, you need to look at the chart. None of this thing should be done blindly. So let me just go over here and open up the page, options with options, type in the QID. I just think so we are not missing much movement in the market ever since we started the session. Market is kind of just going sideways. It's really not doing anything in terms of the huge move. Let's just take some water here quickly. When you're looking right here for the last, I would say 30 minutes, because each of these bars is at 10 minutes. The market is at the pause. But that actually makes sense because in New York is right now lunchtime. And there might be another move towards the end of the day. We just need to know whether it's going up or down. So when you look at here, a majority of these stocks inside the S&P are slightly more red than green. Now you have big names such as Amazon, Tesla, and an energy sector that are up, and a Home Depot, right? They represent about 50% of it, but while the 43% is declining, and if the tech is declining, it's complete indecision. It's a flip of the coin. So what I'm doing right now, I'm bringing in the QID here in our platform, just to look at here at which level I can sell something. Well, maybe I can sell something above the 17. So we're talking about selling the call. So selling the front cycle call based on the resistance at 17, right? So in that case, we would do sell to open, 17 call, at the bid, but in reality we will get filled at mid. So if I'm going to do this, it's important for me to actually take a look how many of these calls are being actually sold at that level. So one of the ways to do this is you go over here where it says add a study, and then you can look at option value map. So I'm going to click the option value map, and then I'm going to just pick the 3 cycles, right? So I'm going to pick the 3 cycles here, and I'm going to simply apply this, and you're going to see a lot of information over here that's going to be loaded up. So information that supposed to be loaded up here is containing the information regarding the activity on front. So the one thing that I don't like is that QID does not have a weekly options. It has only what? Monthly options. The choices that I'm given are June, July, then nothing for August, nothing for September. Then they skip to October, and then they give me the January, and then there's nothing else till the January 20th. But that's the product I picked to trade, and that's the product I'm going to trade. So when I click over here and switch this to the volume and open interest, and I'm going to just have a minimum amount of the strike prices, I want you to take a look over here. We are now looking at volume, and I'm going to make a volume into red, and volume just represents the activity for today. So when I selected that and I didn't get anything, that means nothing was traded today. But if I click on option open interest, which means I'm going to select that, let's say in orange, there has been quite a bit of activity here at the 16 and the 17 strike prices. Now notice the 16 strike price is what is called out of money, and 17 strike price is what? Out of the money. So I'm more interested in actually selling 17 because I have seen it on the platform that's where a lot of activity is. So we have here around the 17 a lot of activity. We have a lot of activity here on the 17. So we're gonna now sell 17 after I actually lay down the whole case for a bid and ask. So be aware of it. We are selling this call. We're selling this call. By the way, those of you who are joining late, the room number is 95225. Feel free to download the Speak Up app, and then you can interact with me just like these other people who are saying, good, I see it, buying power, okay, buying power effect, okay, good. See you and I can hear you, okay, so this is good. So whoever is here is interacting with me. That's good. So what I'm trying to point out to you that I'm bringing in here, again, bid and ask, right? So we have a bid and ask, and these are the dollars. So I know they're quoting them in the pennies, but this is the thing that you need to multiply. With options, everything is about the multiple, right? Because it's being quoted in a sense, but in reality, it's in dollars, right? This bid of the 0.35, when you multiply it by 100, because each contract controls 100, right? So one option contract controls 100 shares. That's really $35, right? And over here we have a 40 cents, right? We have a 40 cents, which again you would need to multiply it by 100. That is $40. So most likely I will be able to get filled here around I would say about the 38 cents, but we're about to see what is going to happen. We're about to see what is going to happen. So what I'm doing right now, I'm looking now similarly to what I did before, that I want to sell now June, but of this year, 23, not the 13 call, but what? 17 call. So minus 17 call, right? That's the one that we're doing, and I'm selling that. So 17 call, I'm going to click right here, and I'm going to click single, and I'm going to do the market, and whatever they fill me, and I'm gonna be making sure that you recognize here that if I get filled, I still need to pay my commission, which is a 65 cents. So here it's saying selling at the market. I didn't get filled. Okay, now I got filled. Okay, I actually got filled on 35. I got 35 in a margin account. So now when you're looking over here, we have a three-legged creature. And why do I say that I have a three-legged creature? Because first of all, I have a position that is long, net long, against which I have shorted one call. And when that call expires, what can I do then the following month? When expiration comes in to June, and let's say we close at 16.99. Okay, so I'm gonna just put here that I got filled to 35. So in this case, I didn't get the price improvement. I just got what I asked, right? So now you're saying, well, then your whole outlay has changed by amount of what? $35. So then really, like in my account over here, I will have an outlay of the money of the 1635, and that is for what? For June. When July comes, can I sell another one for, let's say, again 35 cents? In that case, if I sell another one for 35 cents, that's going to bring it to 16. So now you can make an argument, well, you can do the same thing over here for IRA. So let's do the same thing for IRA. So what I'm doing right now, I'm switching from a margin account into IRA. And this is where I need to disclaim it. Depending who your broker is and depending on the option level approval, you might not even be able to trade this particular product because it's not normal stock. And it's what I disclaimed earlier when we start trading this, that this QID does not have earnings. When you look at it here, there's nothing in earnings here. Okay, it's not completely normal product. Be aware of it that it's the inverse side of the QQQ. So as the QQQ is going up, this thing is going where? Down. So just be aware of it side by side. If I would have a QQQ, you would see that the market is ripping where? Straight to the upside. QID is ripping where? Straight to the downside. So if the QID is down, and look at the percentages, 0.25, then this is actually up double of it. So it moves twice in the opposite direction. Now I know on a $16 that's not that much, because on $16 that's not a big deal, right? But just be aware of it. When this thing moves, there can be really significant movement. This thing in no time can rally from the $16 to $19, maybe $18, even $20. So just be aware of it. This is how this product works. Having said that, in this account, which is a paper trading account, and I'm now on IRA, and I have not paid any commission whatsoever, right? Because as of now, what have I traded over here? If you're looking right here in this area, I have only traded stock, and Thinkorswim TD Ameritrade Future Charles Schwab didn't charge any commission for trading stocks, right? Now, if I try to sell the same thing over here for 35 cents, so selling single against the 100 shares that I have at the market, they're going to charge sold for 35 cents. No price improvement. No price improvement. I don't know why this thing didn't update. It's supposed to update, and show me that I actually have an option, because right here I do have an option. I have an option right here. I sold the one, traded price 35, and now I have a position over here. Let's now go back to our platform here and enter all this information that we are really doing. So I'm going to go over here where it says a chain. I'm going to now go into the QID, and I'm going to edit the spread, because this is really a spread that we have here. So what do we have here? we have a situation that we have two legs, and we are actually bullish. Okay, we're bullish. So we have a position that is synthetic. Let me just take this and edit this. Okay, so we sold for a. Okay, let's make sure that I go all the way to the January of 2025. January 2025, $16 put we sold, and then we bought $16 call. That's what we did. Information that I need for that is this information that I've been getting here. The one that we did was for a 320, and that was a put. So right here, we got this discount of the 320. But then the 320 we took around and instantly invested in purchasing 390. Then how much is that net out of the pocket? $70. So knowing this, I can have a computer tell me the same thing. So we were able to get the 320, and over here we were able to pay 390. So when I click here, OK, you have this information that is presented to you that you're synthetic long. So we're doing the synthetic long for 70 cents. Okay, so I'm presenting this right here. So net, I have a trade in which I have ponied out of the pocket $70. But is there a margin? Yes, there is a margin. So I want you to look at right here. I know I have two accounts and I keep switching, but I'm making comparison of trading the stock versus trading a synthetic. In trading a synthetic, they simply went into my account and they took the $1,607 out of the original $8,061 that I had, leaving the difference of the $6,445. However, in my margin account, I started with about whatever that is, 4,000 or something like that, and I still have it, but they do hold some margin. And a place where you would find out that they hold margin, it's right here. So cash and sweep, okay? So they have a here buying power effect, and this is where you look at the margin. So let me now just explain this one more time, what we did here. Part one of this presentation was to go through the big market and to explain everything that's going on with the big market. Okay? Part two, just answer the quick question here that somebody has typed it in, was to sell $16 put for 320. The moment I got the 320, I turned around and I bought the long call. When I bought the long call, I had to pay 390, which means I spent all of the 320. So the whole trade really net cost was $70. Now when you compare that versus stock buying for $1,607, you see it, but that's just the appearance, because in reality over here you still have a margin, or you have an obligation to have the capital, and I like to use the word on hold. While over here, there's no capital on hold. The market maker already took that money. So this is that comparison. So when I now go back over here to our platform and I single right click here, I'm going to get the risk graph. And this risk graph that you're looking, it's pretty much like a regular stock. It just goes straight up. Okay? So I make money when the price goes where? Up, which means the QQQ, which is inverse, most likely between now and June, when they have a debt ceiling discussion, is going to have some volatility kick in. Just see, even now, NASDAQ is so weak, it's just hesitating to go higher. And be aware of it. It doesn't matter that Russell is today the strongest of them all. Russell by itself cannot pull up the rest of the market up. It needs the Dow, it needs the S&P, and it needs the biggest sector out of all these sectors in the United States. These represent the different sectors. So when I enlarge it over here, you would see the different sectors which box is the biggest box in this table. Obviously, the biggest box is this one that represents about 25 to 26% of everything else. When you look at the financials, they are not as big as a what? Technology. And if the technology is struggling, it's very difficult to believe that the rest of the market could go higher without technology participating in it. You can say, well, the energy is up. Yeah, but the energy is only a certain percentage of it. Like it's not as big and as important. So having said that, I want to tell you this is the way how it looks now. If I now add one more thing to the spread, remember, what do we do? Well, we sold another call, and that was at the 17, and that's going to be out of the money. And I know we got the pathetic credit of only of the what? 35. So when you see that you get the 35 on it, what happens with your outlay of the capital? Well, first of all, over here, the platform can't even define what you got anymore. Because initially, what we got here is synthetic lock stock. The part 3, which I name selling of the call, out of the money call, at the front cycle, has changed this into the unknown strategy. But look what happened with my $70. $70 all of a sudden became a what? Only 35. And this is what I'm saying to you. If I go back over here to the choices that I have here June options that if we close below 17, I'm going to keep that $35. Can I then repeat the same thing for July? By the time July expires, they're going to list August and also September. Can I then keep repeating this? And keep in mind, this is what is happening in the bigger picture, right? Like I have this contract of the long synthetic is until January 2025. So when I look at here, basically 3 years, we have a 2025, which I can sell only once, which means I can only sell the January of the 2025 out of the money call. Okay. Over here, I have a 2024, that's entire year. I can sell 12 months of out of the money calls. Okay. In 2023, I have a June, and then I have a July, and then I have a August. So over here, the total is going to be 7 months. So I have a 7 months plus 12 months plus again 1 month over there. I have only with 20. Even if I'm receiving 20 months of selling out of the money call, 20 months of selling conservative 35 cents, right? Out of the money calls. How's that going to work out for me? Well, I mean, think about it. Like we are now receiving the $35 times 20 times. That's a $700. That's $700 can we subtract out of our original outlay of the capital that was close to, what is it that we did here? 16, no, it was a 1280. Yeah, 1280. Yeah. So out of the 1280, which is what we calculated here when we fired the trade in, 1280. This was in red because this is that margin that I was talking about, because we are doing this in our margin account. By the time January of the next of the 2 years from now comes in, right? My 1280, my 1280 investment is not going to be holding up that much capital because market maker or the broker would reduce it to 580. And what do you think in the meantime is going to happen with my actual IRA? Well, I would still have outlay of the $1,607, and it's only that I'm going to be bringing in. So it's interesting that I have placed this trade this month, May, and we can revisit this again in June and again throughout the entire year and then next year and then in January of 2025. We can actually compare it and to see who is better off, the one that has a long synthetic or the one that simply has the IRA. Well, it really depends, how you look at it. In terms of the IRAs, you have a multiple restrictions. But in terms of the margin account, if you have a higher level of the option approval, you can do this even with the various credit spreads, such as verticals. In this case, nothing in this lesson that I have presented to you was advanced, such as butterflies, iron condors, ratio spreads. It was just very simple analysis. So we started today the stop session, which is a monthly overview by looking at the big picture. And then we move on trading of the synthetic. And this trading of the synthetic was decided to be done on a QID because we are going into the debt ceiling discussion, and most likely that's going to bring the volatility up. And the QQQ that has been high most likely is going to go down. So if the QQQ goes down, then why am I buying the QID? Because the QID, it's inverse of whatever the market is doing. So one more time, if you're looking right now, the QQQ in terms of the percentages is down 0.24%. Let me get this in the blue. 0.24%. Okay? But if I type in here QID, percentage wise, that's going to be a double. So we're actually up on this one. Double of that, right? So think about it when a real movement takes place. The QID that is now flirting with the all-time lows most likely is going to spike up. And these things can move crazy. Look at this particular day. We're talking of the movements of the several dollars from the low of the 26 to the high of the 30. That's a $4 move. I know today is pathetic because we're talking about 9 penny moves. But imagine if this goes from 16, $4 higher to 20. Well, then you can say you're wrong on selling your 17. But what about if you don't sell anymore 17 at that point? You revisit the platform over here. I'm going to just minimize this, and I'm going to bring in the options with the options. I'm going to then show you that you have different levels over here. So if I look at the 55 minutes on QID, I have a resistance here on the 17, but if I look at the bigger picture over here, so let's say a daily, I have them again above the 21. So imagine if this thing rips to the upside. So anyway, just continue with this. So I have taught you how to sell to open a put. That was a part one. The other part was buy to open a long call, and that's why I brought in this little sticky note, and I show it to you how we fill it up. And then against that, I wanted to reduce my overall outlay of the capital of the $70 by 35, and that was a part three. And its keyword to get here is you're always selling the out of the money calls. You don't want to sell in a money call unless you know some inside information and you're certain that something like this is going to happen. So anyway, this was a session in which I have overviewed something. I have placed the trades that are longer term. And if you do this on a monthly basis, we can come back and revisit this. So again, thank you once again for all of you who have interacted here through the Speak Up apps. Thank you for all. And I'll see you in the next session that is going to be coming up very soon. Stay hedged and bye.